Hello, Ms. Lau. The following presentation responds to your inquiry regarding the fair value classification of family finance companies' various investments. The information summarizes the research conducted by Bartolini, Funakoshi, Gallegos, Liu, and Mendoza LLP for instruments held by FFC as of December 12, 2012. We analyze each instrument and their inputs to determine the asset's overall classification within the fair value hierarchy. There are three levels within the fair value hierarchy. Level 1 inputs. Active markets provide unadjusted quoted prices that reporting entities access to measure fair value. In other words, several market participants trade at high volumes and researching prices requires little effort. Level 2 inputs. These are observable inputs in addition to quoted prices. This may include items such as industry performance and trends. Level 3 inputs. These are unobservable inputs not readily available to the public. Adjustments and assumptions allow reporting entities to measure fair value more accurately.
So the first instrument is the collateralized debt obligation. This instrument is unique because its fair value hierarchy classification changed during the year. Before September 30th, the CDO would have been classified as level 2 because of the inputs that FFC was using to value the securities. FFC relied on the quoted price in active markets for securities similar to the CDO. Level 2 valuation inputs may include quoted prices for similar assets or liabilities in active markets. Also, the market valuation approach to value the CDO helps to support level 2 classification. After September 30th, FFC adjusted their inputs for fair value recognition due to the significant decrease in volume, the widening of the bid-ask spreads, and the significant adjustments to observed market transactions for similar CDOs. As a result of the inactive market for CDOs, FFC had to change their valuation method from the market approach to the income valuation approach. The income valuation approach uses inputs that require significant assumptions, such as the discount rate. The discount rate requires several unobservable inputs that measure risk, such as the implied rate of return, the liquidity risk premium, credit adjustment, and the interest rate risk. In addition, the quotes that FFC relied from the third-party broker service would still be classified as an unobservable input because it relied on a third party's proprietary model and their own significant assumptions. Therefore, the CDO should still be classified as a level 3 fair value instrument due to its use of the income valuation approach and the discount rate to value the instrument.
Second instrument is mortgage-backed security. On September 1st, FFC invested in a privately issued pass-through MBS with a state maturity of 30 years. Before September 30, the fair value of MBS was measured using the market approach. Because there are not identical MBS in the active market, the MBS was not classified as level 1. Therefore, the level of MBS was level 2, due to observable transactions with quoted prices in active markets for similar MBS. However, after September 30, the MBS market declined in activity through an increase in volatility by fluctuating bid-ask spread. As an alternative, FFC considered about a spherical income approach pricing model, which takes into account interest and loan payment speed. However, FFC decided an income approach would be too complex for this MBS, because two sources of risk are linked. Also, FFC determines that there are observable inputs, which are prices for those transactions are current and irrelevant to the fair value measurement, and there are observable transactions for MBS and similar MBS. Because FFC concluded that insignificant adjustments are required for the observed transaction, MBS is categorized in level 2.
Instrument 3, Auction Rate Securities. Prior to Q3 2012, it was considered level 2 because of an observable active market every 28 days. After Q3 2012, the observable market failed repeatedly. FFC decided to use cash flow model. For purposes of codification, it is considered an income approach model. The model utilized by FFC used a combination of non-market-based models, including estimates of future coupon rates, prepayment speed assumptions, credit risk assumptions, and illiquidity discounts. This is acceptable under the codification standards because the auction rate security does not have any observable market inputs. Codification standards allow for entity-developed fair value measurements if the entity does not believe other market participants use different assumptions. For purposes of codification, the approach used by FFC is an acceptable method.
FFC's investment in Company X uses a mixed valuation approach. As a non-public company in a niche market, companies similar to X trade at low volumes. In an inactive market, Level 1 classification may not be applied to the instrument. However, the information reported by these similar entities act as a benchmark for FFC to compare X's performance. Using discounted cash flows to forecast future performance contains many entity-specific assumptions. These adjustments increase the instrument's risk and valuation becomes less reliable. As a result, FFC's investment in X falls under Level 3 classification under the fair value hierarchy.
LIBOR is the world's most widely used benchmark for short-term interest rate. It serves as the primary indicator for the average rate at which banks that contribute to the determination of LIBOR may obtain short-term loans in the London market. FFC adopts income approach, which is popular in interest rate swap market. Income approach is a tool used to link future amounts, for example, cash flows or values, to a present amount using a discount rate. Regarding of LIBOR interest swap, FFC should adopt level 2 inputs. Interest rate swaps use known public data such as interest rates and the contract terms to calculate a value of the interest rate swap. The instrument can be valued indirectly using observable data. The fuel swap is similar to Instrument 5, interest rate swap, because they are both fixed for flat swaps that trade over the counter. In addition, both the fuel swap and the interest rate swap utilize the income approach to the valued instrument. The fuel swap adopts the income valuation approach in which the swap's present value is based off of the future amount of income associated with the forward price of gasoline and adjusted for time using a discount rate. FFC appropriately uses the income approach to value the fuel swap because there is not an active market to derive a market value for the instrument. The fuel swap should adopt level 3 of the fair value hierarchy based upon the unobservable inputs that FFC is utilizing to value the instrument.
In conclusion, the fair value classification of FFC's financial instruments is dependent upon factors relating to the level of activity within the respective markets and the method used to value the instruments. When identical or similar securities are traded within an active market, FFC may use market quotes to value their instruments, which is also known as the market valuation approach. The market valuation method can be used to value instruments in level 1 and 2 of the fair value hierarchy. We believe that instrument 2, 3, and 5 should be classified as level 2 instruments because there is an active market for similar securities. In general, the fair value hierarchy classification of a financial instrument is level 3 if there is an inactive market for identical or similar securities. FFC correctly identified the market for instruments 1, 4, and 6 as being inactive. In order to appropriately value an instrument in an inactive market, the income valuation approach can be utilized, which requires significant assumptions that are unobservable. As a result, instrument 1, 4, and 6 should be classified as level 3. Let us know if you have any further questions concerning the fair value hierarchy classification of your financial instruments. We will be glad to discuss the matter further with you.